Good rainy afternoon, everybody. My name is Cameron Dawson. I'm the Chief Investment Officer at New Edge Wealth. We are going to have a conversation today called Credit is Due about credit markets. And there's probably no two other people in the world that I'd rather have a conversation with credit about. So I know both of these people do not need an introduction, but I would like you just to introduce yourselves and what you do in credit, just to set the table, and then we're going to have a broader discussion. So Joe, let's start with you.
Thanks. Happy to be here. Joe Hegener, I'm the founder of Astrozoa Capital Management.
Mike Green, I've been up here a couple of times today.
Great. So the way that we're going to structure this conversation is we're going to talk about the macro environment for credit, and then we'll get to the so what. What do you actually do about it? So in a way, we'll start by talking about the risks, and then we're going to move into talking about the opportunity. So it's no question that credit is expensive. So Mike, could you lay the framework or set the table just to talk about how expensive credit actually is?
Well, I mean, the statistics out there are very straightforward at this point, right? Credit spreads as measured in the cash market, and this is actually an important distinction between cash market and the derivatives market. So CDS is still sitting right about 300, a little bit more. The cash market in high yield got as tight as, I think it was 262 this past week. That in and of itself is actually telling you something, that the shortage is in cash paper. And one of the real challenges, Joe certainly encounters this, I know I encounter it. When you run a high yield fund, your product is self-liquidating. You have product that matures, paper that you receive the principal back on, you receive coupons. It's fairly typical for a high yield fund to receive between 20 and 25% of its cash that is actually outlaid in any given year back in the form of interest payments, principal maturities, et cetera. You have to figure out how to reinvest that. And in a high interest rate environment, there's just not a lot of paper that's being issued. And so you're actually watching the tightness of the market develop as people are basically chasing secondary paper because they have to show that they're invested.
And you've been pointing out that you've seen the average maturity of the high yield market go from 6.5 years to 4 3/4, but it's starting to creep back up again. So would you expect some of that supply demand imbalance to start to correct itself?
Anytime you see this type of tightness, and again, we saw a little bit of a pop in credit spreads just today. Anytime you see this type of tightness, you are going to see supply increase. And that's what the market is signaling. It's saying, please give us more paper. We want more paper to invest in. Companies will take advantage of that. And that is exactly what you're seeing when you describe that. That weighted average maturity ticking up is new paper coming into the market to address that shortage.
And so, Joe, as you look at the outside corners of the credit market and you look at some of the more esoteric things, have you seen the same kind of pricing premium reflect itself in spreads in areas that aren't just your typical high yield or IG?
Yeah, absolutely. And I mean, further to that point too, I think the tightness in the market that Mike's referring to is directly correlated to the explosive growth that kind of more esoteric ABS securitizations have experienced over the last year, 2-3 years. And so to an extent, we are participating in some of those deals, but my goodness, I mean, some of these collateral types are very out of the box. They're securitizing these, wrapping it up, going to new issue, and the most levered portion, the B-rated tranche at the very bottom of the capital stack that might be 20 times levered, tied to somewhat questionable collateral, might be 20 to 30 times oversubscribed at new issue. And we're talking about SOFR plus 500 for that type of a security. So the amount of embedded leverage is substantial. And so the risk return profile in our view, even in the esoteric space is very skewed to the downside.
So that raises the question of, are investors getting properly compensated for the risks that they are taking? Because it's one thing, I think we should talk about why prices are tight from a structural standpoint, some of that supply and demand, but let's talk a little bit about that cyclical aspect of things. We just got a GDP print today that was the strongest in a few years, and that we continue to have this economy that's expanding, but are we getting properly compensated given the underlying credit risk?
So I think one of the difficult things as it relates to fixed income, right, is there's sort of an asymptote, right? Equity markets can rally ad nauseum, right? Apple can trade at 20 times earnings, then 30 times earnings, then 50 times earnings, and can keep rallying, right? But the junk bond that was issued a few years ago very likely doesn't trade at 125 cents of the dollar, right? It could. I mean, if you look at Carvana's bonds, right, they're trading at about 120 cents of the dollar right now.
Why?
Well, because most of their coupons are paid in kind, of course. But so it's a really challenging proposition, right? I mean, if you're playing in the equities landscape, at least the upside downside is somewhat, is somewhat even, right? You want to argue whether we're in a bubble or not. That's a whole other story. But with high yield, you're kind of picking up pennies in front of the steamroller if you're not very, very careful. You're clipping coupons, but your downside risk is substantial. I mean, especially if you're at the bottom of a securitization, you could lose everything if the underlying collateral default rate goes up by 1 or 2%.
Yeah. So, Mike, then how are you framing this kind of balance between, okay, we know we have these structural factors pushing yields lower, pushing spreads lower, but looking as well at the cyclical side of things?
Well, I'd say that there's a couple of things. So first, the demand for fixed income or income in particular is just off the charts. We see it in our industry in the ETF space. Eric Balchunas, regularly talks about boomer candy, right? Things that are yielding a tremendous amount. Almost all of these basically take the form of creating synthetic debt, right? What you're doing in a call overriding strategy is you are creating non-underwritten corporate credit. The key difference, I would argue, is that is often being done against relatively high underlying quality companies. I'm not worried about Microsoft going bankrupt, for example, but you also have none of the covenants or any of that sort of stuff. And one of the things that I would argue has actually been happening, Jeff Kivitz unfortunately couldn't join us for health reasons, but one of the things that's been happening is the very low quality covenants that were introduced 3 or 4 years ago as there was a genuine credit cycle in terms of an unbelievable amount of money that was basically chasing in with very low interest rates that led to lots of dubious financing, et cetera. That led to credit agreements that were extraordinarily weak in terms of their construction. Ironically, that actually means they're much more like equity. And so it's actually easier to do a restructuring of credit in which there are very few strong covenants and protections because you basically recognize that management can completely screw you in the process of renegotiating this. And so it's facilitated some of the dynamics that we're ultimately seeing. In terms of how I'm personally positioning for it, I think this is actually an incredibly rich environment for buying some protection against the downside that Joe was describing. We have seen an extraordinary rally in very, very low quality equities, unprofitable companies, et cetera. That's a key component of how I think about my quality junk overlay that I apply to the CDX strategy. We also are seeing CDS very tight, both in high yield and IG. We've taken advantage of the opportunity to hedge with some of those exposures. As I said, high yield hasn't come in as much. IG actually very briefly came in and exactly as you might expect, given the surge of issuance, has now popped again, right? So we're seeing slightly higher bid for protection in IG. And we've been fortunate to take advantage of some of the opportunities to position around that stuff. I would say the thing that I'm most concerned about right now is actually not even on the credit or corporate side. It has much more to do with economic policy. And so, we're now watching the inevitable second guessing of Jerome Powell cutting interest rates this summer. Inflation on a seasonal basis is likely to pop up a little bit. And there's a little hunch out there that says to me that, the next stage in this process is going to be the Federal Reserve being forced to confront the inflationary effects, or at least the measured inflationary effects of some of the tariffs, and corporations being able to take advantage of this. It'll show up in CPI on a seasonal basis, and all of a sudden we'll be discussing should they be hiking interest rates again is actually a real risk that's out there.
Yeah, we've been in this environment where because base rates have been so high, it's created a ravenous demand for credit. But if you actually do have a Fed that starts to cut base rates in a more meaningful way, could that sap some of the demand for credit from individual investors? I know from our kind of clients, it likely would.
I think that's absolutely right. I also would emphasize, though, that there are areas of the credit market. Ironically, I would point to areas like private credit right now. And again, not to pitch this, but this is why we introduce funds in the way that we do. We just introduced a private credit fund that also uses some of the overlays for hedging purposes. The irony is if the Fed actually does start cutting rates, it doesn't really do that much for high yield unless the economic conditions are great, because then you can go and refinance at lower rates. But the key advantage for private credit is that they've got floating rate debt, and so actually their credit quality theoretically improves as you cut rates at the same time that high yield, if you're cutting rates for economic reasons, actually sees its credit deteriorate and credit spreads widen. And so the two behave very, very similarly as underlying assets, except in these two kind of isolated areas.
I know that Jeff was supposed to be with us today, and he was going to be our private credit guru, but we can't ignore how much private credit has distorted these markets. So there's been some things that have been good, right? It's siphoned off some of the lower quality things that used to be in the high yield index, but we also know that there's probably a lot of junky stuff going in underneath the surface of private credit that may be masked by the fact that so many people have such high demand for it.
Yeah.
The inflows really do help mask maybe what's going on in these underlying portfolios. So let's play this through. Fed cuts interest rates. You have less demand for private credit because it's floating rate from individual investors like our firm. Does that start to reveal more bodies potentially within the credit landscape that are sitting within private credit?
Wow. Well, the rising tide definitely lifts all boats, and the same thing goes the other way around. And I thought Jeff, actually, when we were on the call to prepare for this meeting, our panel rather, made a really interesting point as it relates to restructurings and workarounds. And so going into 2024, I personally, there's a very large maturity wall that was coming up within high yield, all the debt that was issued in 2020, right? And I personally thought that there was going to be a surge in bankruptcies. And we didn't really see that. What we actually saw was a surge in out-of-court restructurings. And something that I kind of underestimated was the alignment these days between the debtors and the creditors to sort of extend and pretend or kick the can out another 5 years, right? I mentioned that Carvana bond, not to pick on anybody, but effectively they had $3 billion worth of debt due in the span of 12 months. They were out of cash. They were citing their real estate as available liquidity in their earnings calls. And the creditors agreed to kick the debt out another 5 years, took a small haircut. They increased the coupon to 14%, even though most of it's paid in kind. And it gave them a new lease on life, and now they're profitable now. And I actually haven't been following them too closely since, but we watched the stock go from $300 to $5, and it's rebounded since. And so we didn't really see that surge. But the point that Jeff made, what I thought was very interesting, right? Within private credit, there's not really any economic incentive to reorganize, force bankruptcies, force restructurings, right? If there are bonds that are trading for 60 cents on the dollar in public markets, as an investor, I can go and buy those bonds. I can dangle a refinancing packages in front of the company. I can either force the company into bankruptcy, do some kind of a workout, and there's some kind of an economic incentive for me to actually, restructure the business. Whereas in private credit, right, the lenders and oftentimes the private equity sponsors of the LBO or that deal are very, very aligned. The equity sponsor wants to keep their equity, and the private credit does not want to take a haircut or a write-down, right? And so their willingness to actually work together, maybe contribute additional equity capital, extend that loan out a couple of years is much more aligned. It's actually better, frankly, for the investor, right? Whereas in public markets, it's so much more antagonistic. It's very kind of, capitalist, yes, but you stand to lose a lot more if you're not careful, and it's particularly in cov light or unsecured debt.
Well, so let me just add a couple of points to that, right? I mean, one of the reasons people will often talk about private components as being like a club, right? And in many cases, what Joe was referring to is sometimes they're so aligned, they even have the same name on the door, right? The issue with that, just from an actual economic standpoint, forget the morality of it, is ultimately that it's very similar to the dynamics that emerge when you have country club banking relationships, right? I lend to this person not because I've actually done a credit search on them or a credit analysis of them, but because they're a good guy on the golf course, right? That means that individual doesn't have any apparent issues with financing their lifestyle because I'll lend to them because they were a good guy on the golf course. And as long as they continue to be a good guy on the golf course, we're going to continue to lend to them until suddenly you wake up one day and they've moved out of town, disappeared without a trace, right? And then the entire town is suddenly like, well, why did our local bank go out of business? Well, it was that good guy on the golf course. There are very similar dynamics here, right? What you are seeing with the PIK loans, et cetera, these are equity, these are not credit. They have credit characteristics to them. People who listen to me sometimes hear me talk about financial primitives, right? There are basically three financial primitives: currency, debt, and equity. Currency is that which cancels debt. Debt is that which cancels equity. Equity is the surplus that is then invested back into currency, right? It's a trinity that functions very much like rock, paper, scissors. None is stronger or weaker than the other. When you have a credit intermediation function that fails to do its job properly, right, it actually is creating conditions under which lots of that equity is being fake in terms of its creation. And unfortunately, I think that's the direction that we're ultimately heading on a lot of this.
I mean, we always sow the seeds of the next crisis in the prior expansion. And so I think that it leads to an obvious question, which is, what breaks this cycle? Because there's been a lot thrown at it. There's been bank failures. There's been all the uncertainty with tariffs earlier this year. What actually causes us to have a real credit cycle? Then I want to talk about the policy response to it, but let's kind of play out what could cause this cycle to break.
Gosh, well, I have a very similar macro bias or view to Mike. I personally think it's incredibly difficult to make the argument that policy rates are very tight right now. I mean, equity markets are all-time highs, crypto's going parabolic, retail speculation is in a frenzy again, SPACs are coming back, and we have pretty much full employment, et cetera, right? And so it's difficult, in my view, to justify aggressively cutting interest rates. Where I think I might differ from Mike's bias, though, is I kind of think we're in 1996 or 1997, because it's very difficult for me to identify a catalyst that stops this train, right? The thing that burst the dot-com bubble was the Fed hiking rates, right? And we just cut them, and very likely we're going to have a big shakeup in the Fed, right? Trump's going to hand select the chair next year. He's going to have sway, and I think we're about to just punch our foot on the gas. We're about to spend $4 trillion fiscal stimulus. We're going to deregulate. The SEC pretty much doesn't exist anymore, at least in its former flavor as what it did prior. And so this melt up, I think, is. I personally don't see any catalysts in the near term that kind of unwinds the trade. I do think that you need to find a seat when the music stops, but it's difficult for me, at least. I mean, I could maybe point to CLOs. There's an incredible amount of leverage embedded within private credit in the CLO market, but I'm not sure that actually breaks just the insane amount of liquidity and buy the dip mentality that's existing at present.
Is there enough layers of leverage, kind of turtles all the way down, that you could start seeing counterparty risk if something small breaks within CLOs? I
think it's a little bit. So I mean, this is one of the points that I try to continually emphasize. Right, we often think about the dynamics of fighting the last war. I don't actually think the core of the issue this time is credit. I think the core of the issue this time is that we have extended credit on the basis of equity, right? So again, think about those financial primitives. One of the shortcuts in credit is to say, well, it's a $100 billion company, right? The equity markets can't be that wrong. Clearly, I'm okay lending to it, right? We're seeing that actually ironically play through in what many people think are loose financial conditions. If you actually look at the traditionally credit-sensitive components of the economy, housing, autos, et cetera, they're in the toilet. Right? If you look at the areas of the economy that we often think of as credit sensitive, construction, particularly on the commercial side, those are going gangbusters, largely for reasons that Josh and Ben and others have hit on, which is that we are using equity to fund them. And so this is very much like 96 to 99 or 2000. This is an equity bubble. This is not a credit bubble. It has different characteristics to it, it has different behaviors to it. But this is unquestionably an equity bubble. And that equity bubble is in turn leading to Michael Jensen's 2004 paper, The Agency Costs of Overvalued Equity. Mm-hmm. You have companies that are very actively engaged in what I think Josh very well described as highly unlikely to pay off investments that may allow them to preserve their existing business model. Right, and so we've expanded multiples under the idea that, personally, as you know, I think it's more mechanical in its construction, but the narrative is we've expanded multiples because these companies face extraordinary growth potential in front of them in terms of earnings and increased ubiquity. My hunch is that we're going to find out almost identical to what happened in the fiber build-out in the dot-com with telecoms, that all of that turns out to be true, but it's a pricing that causes aggregate revenues to fall.
So if we then think about the Fed cutting interest rates, do you see this as a scenario where Fed delivers cuts almost regardless of what's going on within financial conditions, what's going on with the economy, because they do pay $1.13 trillion in interest expense, so there's a reason to cut for them, or for Treasury. That as we see that, do you see credit leverage ratios starting to go up to the point where this goes and transmutes from being an equity bubble and starts spreading into credit? Because that's what we've seen over the last couple of months is big, huge credit deals out of the Mag 7 of raising capital, Meta raising private credit capital to build a data center. Like, why do they need our money? But I think that you're starting to see more reliance on debt markets. Does that get accelerated as interest costs go down?
So this is the question: are we in '97 or are we, 2 minutes to midnight in December 1999? I lean towards the 2 minutes to midnight in 1999 because, among other things, like the private credit deal that you described that Meta engaged in is not actually just the accumulation of $26 billion worth of debt that was taken on, actually, or provided by Blue Owl Capital. They also have an operating lease agreement associated with it. So it is not $26 billion worth of debt. They're on the hook for $26 billion worth of debt and the operating leases. And so these are extraordinary growth of credit that we're already seeing, and it's happening in an explosive fashion, but it's largely captured off balance sheet in the form of what are called variable interest entities. People may remember a company in Texas that aggressively used variable interest entities.
It starts with an E and ends with an Enron?
Yeah,
okay,
that one.
Cool. Thanks.
You also are simultaneously seeing other behaviors coming from the exact same company that are a perfect mirror for it. Almost nobody is old enough at this stage. It's one of the benefits of getting old. Is in February of 2000, Enron announced that they were going to begin trading broadband. Mm-hmm. Right? Anyone know what Meta just announced they're going to begin trading? Electricity. Mm-hmm. Right? I mean, it couldn't be sweeter in terms of the comparison. Now, I want to be very, very clear. That's not like where you stop your analysis. You actually have to look at these companies and understand this. But there is an extraordinary amount of investment-grade debt in particular that is flowing out that, in my opinion, is very high risk.
So 2000, 2007, there was a short-term funding market crisis. Do we get that after 15 years of QE where so many people have termed out debt, people aren't using commercial paper like they used to? What breaks it?
Well, you just answered your own question, right? I mean, that was true in 2021, is that everyone had termed out their debt. And so the credit cycle that Joe identified absolutely happened. We've seen, for those of you who follow my work, you've seen surging bankruptcies for smaller companies because they were not able to term out their debt in public markets in the same way that many high yield companies, who are truly not small companies, right? Let's be very clear. The average borrower in high yield is issuing somewhere in the neighborhood of $500 million worth of paper before you even get to the context of their equity value. So these are not small companies, but they are much more vulnerable companies. I think we're already starting to see that. The credit cycle has begun. It's hitting smaller companies. We're starting to see larger companies. Simultaneously, Carvana's securitizations are trading at 120, while one of their direct competitors just filed for Chapter 7 bankruptcy and liquidation. It looks like recoveries are going to be somewhere in the 40 cents on the dollar on their bonds, which were also trading at par, slightly above par, just a couple of weeks ago. This is a market that doesn't have information in it. Right? You'll notice that absolutely nothing certainly nothing that will ever come from me is going to involve any form of security analysis in the high yield credits that I own. I take advantage of market features to try to offer a differential perspective on it. But when you actually ask people who are supposed to be looking at the companies, they really don't anymore. Right? They're trying to manage the cash flows that I was describing. They're trying to monitor against a benchmark, et cetera. There's just not a lot of credit analysis that's done.
So now that we know that the world is ending either in 2 minutes or in 3 years, before we get to what we want to do about it, I do want to play my favorite parlor game, which is, what do you think the silliest thing is that's going to end up on the Fed's balance sheet in the next down cycle? Given the fact that we know that in 2020, the Fed was the 8th largest shareholder of HYG at one point.
Yeah. Crypto.
What crypto?
Ooh. I don't want to get political, but
Trump coin.
Trump coin.
Okay, got it. Cool.
I'm just teasing.
I'm not sure I can top that. I don't actually think that's going to happen in this cycle. But I think that it is highly likely that we will continue to see things already ending up on the Fed balance sheet that we're not thinking of them like that, like Intel. Right? These are just equities that we're taking onto the federal balance sheet.
Do you think BDCs, any of the private credit guys, could need a bailout?
Yes.
Yeah.
I actually think that there's going to be quite a few of them that end up needing it, but we'll see.
Do you think that this credit cycle is something that the degree of credit cycle is imminent, or do you think it needs more time to build to get even more extended, Joe?
Sorry, so how am I to understand that question?
So meaning that if we have, let's say we have a recession at some point in the next 12 months, is this the doozy? Are we extended enough in credit that you would see that degree of bailout, or do you think that you need probably the next cycle for things to build in an even more extreme way?
Oh, God. Well, I kind of am of the mindset that the can of worms has already been opened. I mean, we started this grand experiment post-GFC with, quantitative easing, and it seems like our tolerance for macroeconomic pain is just getting smaller and smaller and smaller. And, and so I kind of feel like there will be an immediate policy response the moment things start to look like they're going to break. Now, how the market reacts to that, I don't know. I mean, I kind of, I was doing a different interview earlier this morning, and I made this analogy where, rather than a bell curve, I kind of feel like it's just like an M, right? Where there's so bimodal, these two outcomes where it's either over and policy responses aren't going to work, which I don't think is necessarily the case, but there's going to be a lot of pain before the V-shaped recovery. Or we're just going to paper over everything. Every component of weakness that we see, we'll paper over it. We'll throw the bazooka at it from a quantitative standpoint, whether it be fiscal or monetary stimulus. And what's another trillion type of mindset, which I think very much exists within not just our government but policymakers.
Moral hazard.
Yeah.
So again, I have a slightly different take, although I'm extremely sympathetic to yours. Look, I think the political discourse is broken down. That makes it much harder to respond. Romans had a solution to it. It was called a Kaiser or a Caesar. That's likely the direction that I think we have to go before we actually end up resolving many of these things. Caesar rose to power in a debt jubilee. My hunch is that sits out there somewhere, but I think part of what will actually create these conditions is the fact that nobody actually wants to do stimulus anymore. Nobody actually believes that, they just think it causes inflation. And so I think there's actually much more resistance to what you're describing than support.
My theory is that they're going to rebrand quantitative easing as quantitative freedom. So
Probably good.
Let's talk a little bit about what we do with it. And Mike, and this is not meant to be a commercial or a PSA, but as somebody sitting in my seat running a fixed income ETF portfolio going, I'm really nervous holding credit right now. Having something that gives me some downside risk where I'm not having to manage that exactly myself has been very helpful. So let's talk about the approach to mitigating downside, staying invested even through a cycle, and how you can do that given the starting point of where spreads are today.
Yeah, so look, I think one of the most understood or underappreciated quotes of the last 25 years was Chuck Prince when the music's playing, you got to keep dancing, right? The simple reality is many people, myself included, might have looked at financial conditions and financial markets a year ago or 2 years ago and said, this is crazy, I'm out, you should do X, Y, Z. You can't know when it's going to end. You can't know when it's going to end. But what you can do is you can take advantage of opportunities that other people are ignoring. And so within CDX, within the high yield fund that I run, one of the key components is to identify hedges that we can carry, right, that aren't going to kill us. One of the tools we use for that is an equity overlay that is matched up against the credit indices as compared to the equity indices. The underlying design of it is to offer a payoff to credit spread widening. Simple idea is you're long companies that never need to tap capital markets, you're short companies that are continually tapping capital markets. If you match those largely on a sectoral basis, you're going to end on a size basis and you equal weight so you don't have huge idiosyncratic exposures. You end up effectively isolating the credit refinancing risk. And that has worked very well for us over the past couple of years. It paid off extraordinarily well in the March-April time period. That is now tightened back to the levels where we are full-throated. You should be all over this stuff. I've already made the pitch for, in particular, IG CDS. I think that actually offers some compelling value right now. It's not costing you much in terms of carrying it. It solves some of the basis risk differentials. I would suggest that the key component is you're being given an opportunity to identify relatively long-dated hedges at this point that would allow you to at least partially participate in the upside while saying, I don't really believe it. And so that tends to define the approach that I'm taking right now. But I want to emphasize, like, the music is still playing, right? It is worth making sure that you're dancing. There's beautiful women around, et cetera. Being the schmo who's sitting in the seat staring at everybody else saying, they'll figure it out eventually, right, is not a particularly useful place to be.
It's a challenge, though, because it's so darn episodic and it moves so fast when it does actually start to break.
I agree, which is why I emphasize, like, you put it on when you can, and sometimes it works and sometimes it doesn't, but at least you're still playing.
So, Joe, given that you dance in some of those esoteric corners,
Sure.
Talk about where you're finding opportunity today and maybe how you see that opportunity evolving in today's environment where music is playing, and then how the opportunity set changes once closing time by semisonic starts to play.
Sure. So, I mean, the beautiful thing about credit default swaps, right, is the tighter that credit spreads go, the smaller your insurance premium is for the protection, right? And so as credit spreads compress further and further and further, from a carry profile, from a drag standpoint, it's just de minimis. It behooves you. You buy insurance when you don't think you need it, type of philosophy. And so, if you give me or anybody, $100 million, and you make a bond portfolio that yields 8 or 9%, we're happy to take 150 basis points of that income and purchase downside protection and sleep at night. And so we also leverage Mike's, very brilliant quality junk overlay, and we own credit default swaps as a broader macro hedge. As it relates to the core holdings in the portfolio, we really do try to focus on more idiosyncratic drivers of risk. Right, so there have been a ton of restructurings over the last 18 months or so, and what we try to do is look across the capital stack. There's first lien secured debt, second lien unsecured debt, preferred shares and common stock, and all of these have different markets and different pricing. And so what we try to do is identify what we would call like a fulcrum security, where the best risk return is either in the second lien secured bonds of a distressed company trading for 10 cents on the dollar, or maybe it's in the first lien secured debt that's trading for 99 and it's just got a good carry profile. Or maybe it's in the preferred shares that are trading for 5 cents on the dollar and you think this company's actually going to pull through and reinstate its equity. And so we try to find those more idiosyncratic stories rather than just being long market beta. And frankly, as a manager, it's a difficult proposition to introduce that much tracking error into your portfolio, but we do it intentionally because we do intend to manage this portfolio over an entire credit market cycle and not just try to outperform HYG every quarter.
So you do a little bit within international, and so I know we've had an extreme home country bias in this whole discussion, but any observations of what you're seeing within international markets, and is there more opportunity than what you see in the U.S.?
Well, generally speaking, when we do international, it's more of like a foreign currency or US dollar play, right? So, and it's kind of a hedge, right? So going into this year, we wanted to get short the US dollar. And, rather than just putting on a long MXN US dollar FX trade, we actually just take our cash and convert it into locally denominated Mexican pesos, and then go and use that cash to go buy 10% yielding Mexican government paper, right? Because in that scenario, that trade is carry positive, right, by a healthy margin. And so even if I get the MXN US dollar trade wrong, at least I have this carry coming in to help offset that situation. Whereas if I am right and the US dollar does devalue relative to MXN, then I've got this nice carry boost along with that. So occasionally we'll look at trying to hedge against dollar devaluation by converting our cash into locally denominated emerging market debt and buying sovereign bonds and maybe hedge out the duration.
Asking for a friend, do you still want to be short the dollar?
Here? Oh gosh, probably yeah.
Interesting. Well, we have a grand total of 9 minutes and 45 seconds to take questions. There have to be some. Yes, sir. I think a microphone is coming your way.
Mike, you've had some interesting comments in the past about the changing structure of market-making analysis and the inherent liquidity that exists in fixed income markets. As you watch the evolution of structures and what people are doing in that market, do you think those markets have now become more robust in terms of their ability to respond to stressed conditions, or that there's an unappreciated fragility to them should there ever be a serious problem?
First, any panel that starts with a question from Paul Isaac is a little terrifying. The quick answer is both, unfortunately. And there was fragility in 2008 that was created by the quantity of securities that were held on the bank's balance sheets and the banks themselves being extraordinarily levered. That meant that when they faced liquidity crisis and constraints, they ended up dumping securities onto the market in a manner that was disruptive to price formation. Today, those books are a tiny fraction of what they have been, and those securities are held across instruments that oftentimes are described as buy and hold, right? That creates a totally different set of risks, right? The market is now a mile wide and an inch deep as compared to 6 feet wide and 600 feet deep. It just means that it is easier to create conditions that create shortages of dollars that are needed where they are needed. And so it can creates it creates a different set of risks, I would argue. Like the statistical probability, and this is where I would disagree with Joe on the dollar, the statistical probability of somebody waking up tomorrow and saying, hey, wait a second, I thought I had access to dollars. I don't actually have access to dollars, therefore I desperately need them. Therefore I'm going to sell something in order to obtain them, is markedly higher than it was in 2008. The difference was in 2008, it was a giant pool of capital that needed to liquidate. A lot of my critiques about how we've structured the markets is that those giant pools of capital have moved into unthinking vehicles. I don't know what causes unthinking vehicles to sell other than instructions that come from people who I can't possibly know who they are or what their individual needs are. And so it becomes a much more stochastic probability as compared to a statement of certainty. But the answer is both. Like, we are more robust at the bank level, which is one of the reasons I feel comfortable running strategies in the way that I do, where I rely on bank relationships, versus 2008. And at the same time, I'm very aware that there is a mile-wide, now inch-deep market in terms of what we call liquidity. Prices can move in a much more violent way on individual securities.
Question?
You got a tough act to follow here, Brandon.
Yeah, do my best. So when we talk about being short or long the dollar, it's a purely relative game, right? So if you say like, well, I want to be short the Dixie, that's not capturing necessarily a lot of other currencies. And Bloomberg dollar is obviously a little bit broader, but is it that you're wanting to intentionally be in the other currencies because they have idiosyncratic factors that make them a more attractive currency to hold? Or is there something truly wrong with the dollar and the U.S. policy that makes you want to not own it?
I wouldn't necessarily say I want to explicitly take a tactical bet and short the U.S. dollar. When I say we want to be we want to have that exposure. It's really as a hedge against dollar devaluation, money printing, and inflation, right? And so there's a number of different ways to hedge your portfolio to a reacceleration of inflation, and other ways to express a yield curve steepener. We also have that trade on, and so we're just looking at ways of trying to be thoughtful about continual devaluation and money printing as it relates to fiscal policy, big beautiful bill, Fed cuts. I personally think inevitably we'll get some kind of yield curve control once the 30-year breaks 5.5%.
Quantitative freedom.
Thank you.
So again, I'm on the other side of that. I think that's part of the right question, right? If you're concerned about debasement and uncontrolled money printing, I'm not sure I want to go into the Mexican peso.
That's fair.
And I think that is ultimately the real point, right? Now, there are very good reasons to go into the Mexican peso at points in time. And I would argue that the relative tightness of interest rates has actually changed the forward structure, so it's more attractive to own spot Mexican peso than it is to own forward Mexican peso. But that underlying component, like the US remains the cleanest dirty shirt, right? I sometimes joke, and have said this many times, why did President Bush throw up on the Japanese prime minister? Because he could, right? Why did Trump go to the UN and deliver a bombastic speech that basically told them they were useless? Because he could, right? Do I think it's a good idea? No, I don't think that was a particularly effective or helpful speech, but it actually brings up a very, very important point, which is if the US dollar really is trash, like the world has far more problems than we should be discussing on this stage.
If there's not, I'd love to pull on this thread of this idea that the banks are safe. Because it's
safer, let's be clear.
But it's a very consensus agreement. When we look around, at least it's not 2008, but because of that mile wide, inch deep, does it actually make it harder for us to measure where the leverage is in the exposures and counterparty risk? And thinking of things just like synthetic risk transfers, for example, is that the right assumption that the banks are in fact that much safer?
So I want to be very, very clear. I don't think the banks are safe. I think the banks are safer than they were in 2008. They are less levered. But in line with our discussion around private credit, banks have also done something very, very important, right? The banking restrictions that were put in place in 2008 basically made it very, very difficult for large banks to provide significant pools of liquidity. That inability to hold a balance sheet makes underwriting more difficult, for example. One of the ways that they've handled that is by outsourcing the credit creation function to private credit. And so the banks are actually the financiers of the private credit activity. If the private credit funds turn out to be not quite as good at writing credit as everybody thinks they are, then the banks are on the hook on assets that they currently hold very low reserves against, because it is presumed that non-depository financial institutions have been fully vetted, that they are safe, that their track records show everything, et cetera. And so I do think that there is exposure, but I think it is in the reserves and profits as compared to effectively the solvency.
Let's not show the banks the price charts of the publicly traded private equity names.
Well, not just the private traded equity names. I actually put this into my last Substack, highlighting the discounts of BDCs to NAVs suggests that the reasonably high level of the levered loan market in public markets appraisal is selling at 85 cents on the dollar. To put that in perspective, in June of 2008, those similar securities were trading at 95 cents on the dollar. So this is an interesting situation. There is a very strong disagreement. Fortunately, I'm in the camp that says that no market actually prices anything correctly. It just prices to its current need to transact. I would actually kind of guess that private credit's a little bit cheap, and candidly, high yield is a little expensive, a lot expensive right now.
We have 1 more minute for one more question. Here we are.
You guys were talking about what could possibly end the cycle, and I was intrigued. I'm generally not a fan of stripping out the best components of a concept because tautologically they immediately look worse, but I'm going to ask anyways. In this case, when you consider what tech capex is contributing to GDP, If you were to strip that out, arguably we'd be near or in a recession. So my question is, what could stop the tech CapEx train, or at least slow it down so sharply that we actually have a recession and a cycle?
Well, I mean, first of all, I want to be very, very clear. I'm not a technology analyst. I'm sure there's other people who are far more qualified to address this. But the simple answer is a recognition that you are going to lose the game, right? And so if you listen to what Google is telling you, what Meta is telling you, what Microsoft is telling you, what OpenAI is telling you, what Tesla is telling you, et cetera, I think there's a few more of those. They are all saying they are in an existential race for survival, and they are willing to drive their companies bankrupt in order to win this race. Every single one of them has said some variant of that. Take them seriously, right? What causes somebody to stop that spending is a board of directors turning around and saying, yeah, we're critically appraising our progress on this. We're going to lose this match. Instead of spending the next dollar, let's start returning it to shareholders. Or let's figure out an alternative strategy. And my hunch is that it's literally going to boil down to that. The other thing, ironically, is, we were discussing earlier the 401k reallocations. I think this is, it's funny, Joe mentions the Fed hiking interest rates to end the dot-com cycle. I actually think it was us, right? I think it was portfolios rebalancing and saying, we're overweight tech, we're going to reduce our allocations. I sat on a desk and watched as the NASDAQ crashed and my small cap value portfolio soared as those reallocations came across. So I don't think it had anything to do with the Fed, or very little to do with the Fed. If we choose to decide to take sizable fractions of US equities out of US equity markets and put it into private equity or private credit, that perversely will create conditions under which we're selling the mega caps, and they're going to receive a signal from the market that says something along the lines of, oh, you guys aren't nearly as good as you thought you were, right? And that would actually engender board of directors saying maybe we should rethink our capital spending plans. So I don't know exactly what's going to cause it, but that feels pretty plausible.
So on that very happy note, please join me in thanking Mike and Joe for their time today.